this search for new reality in silver is going to get us up to that 300 to 500 zone. Okay. But probably very quickly, because when this spread breaks out, like it just did in November, usually within a couple quarters of that breakout is when you get your gusher, where you go ape on the upside in price.
Yeah.
We're expecting silver to reach that new reality basically by this summer. So another 3 or 4 months. Because usually these spread breakouts, they yield their results within a couple quarters of the breakout. They yield most of their results. And so silver, if it's going to seek a new reality, could easily be back where it was in 2011, 3.1% the price of gold.
Yeah.
Or what about when it was in 1980? It was 6.5% the price. Good grief, right now we're 1.68 or something, okay? You could double, triple the price of silver relative to gold just to get to the old highs on the spread. So all these factors are saying sudden, now, and new reality.
Yeah.
And then when we do the silver miners, that's a chart at the bottom of that page, you'll see silver miners are broken out versus gold miners, echoing the breakout of silver versus gold. Conclusion, be in the monetary metals, be more focused in silver and the silver miners.
I'm doing that math in my head. Okay. I mean, the gold chart since the breakout about this time 2 years ago has followed us. I mean, anybody can pull up a weekly chart, just a price chart, and see it. It goes up 20% and goes sideways, goes up 20% and goes sideways. Another 20% takes it to 6,000. 3.1% of 6,000 is 183.
Yeah, well, the gold in its prior bull markets, by the way, it usually doesn't do that layered process all the way. You'll do that
interesting.
4 steps up, 2 steps back process during the bull trend, but then suddenly in the latter part of the bull trends that gets you to the new reality, you go more vertical. The behavior changes, which fools people because they're used to the old layered behavior. And they think it's going to, once you've made a high, you're going to stay there for 4, 5, 6 months. In a range, or you're going to pull back. Don't expect that this time. If gold matches its bull market peaks of 1980, 2011, in terms of the ratio dimension of the bull market from bear low to that bull high, bear low to the bull high, those were both 8-fold moves. Gold's bear market low was 1,050 in 2015. 8 times that says I could go to $8,500 gold just to match the dimensions of the prior 2 bull markets. And what's really curious is that we've had this analysis for quite a few months now. Not saying we're just going to go to 8,000 plus. That's just the norm. I mean, we'll probably go well beyond. Suddenly now some major brokerage firms, big name firms, have come out with similar numbers saying, hey, we could see $9,200 gold. JP Morgan, I think, just came out with that, based on certain mathematical relations to monetary degradation and so forth and so on. But, a lot of big firms are now coming out with our numbers for various reasons, which is interesting. But I think that this bull move is now in the acceleration phase, where we're going to get most of what you're going to see, most of the rewards you're going to get if you're long will occur between now and summer.
Michael, what would have to happen? I mean, you've been on this, like you said, since June, reiterating things last year. I remember you talking about, it's going to get to 80 by the end of the year. And I was like, my God, I love you, Michael, but geez. And then here we were. And now, so what, this is all very compelling, and you see the numbers for the metal and you translate that to the miners with their leverage versus their margins. And you think, well, I can certainly see why then the gold shares and the silver shares should be breaking out as well as a ratio. My last question is, what would cause all of this to reverse in your mind to go, you know what, we're going to have to rethink this?
We don't see the technical dynamics for a top. And when we see a top, and by the way, we do call tops in gold. 2011, 3 months off the high, we said, that's it. It's over. Bear market coming. Well, the bear market really didn't start to unfold till 2013.
Right.
We labored off that $1,920 high in late 2011, dropped down. And in December of 2011, we said, we're bearish. And it floundered for a year and then finally crashed.
Okay. Yep.
But there were reasons for that, not just the price chart. There was a momentum structure. When you plotted the annual momentum of gold versus its 36-month average, for example. It oscillated. You had an 8-point uptrend line that you broke. You couldn't see it on a price chart, but on momentum said, God, you just blew the bridge over the River Kwai, man. Okay. And that we said, that's it. You're done. And it took a while to collapse. It finally did. We don't have any such structure set for gold and silver right now. In other words, before you really top and have a major pullback, like silver goes to 500 and then pulls back to 300, let's say, probably you're going to have momentum structures develop, and they're not there now. You haven't even developed the structures. Up under the market where if you sneeze off the high, you're going to break the structure. Right now, any structures we have that you could break and look at a momentum chart and say, oh, it broke its trend, they're not even near the market.
Got it.
So therefore, we do not think there is any major downturn potential here. That
It's
instead,
not yet, huh?
Yeah. Period.
Well, my friend, you can count me as a fan. I know at my TF Metals Report site, you've got fans galore. And I know Eric, when Eric and I did our year-end wrap-up a couple months ago, he was raving about the job you do. Tell everybody more about momentum structural analysis, where they can find your work.
Well, it's olivermsa.com, olivermsa.com. Ask for some sample copies. We explain our unorthodox methodology there pretty well. It's not what you're used to seeing, normal price chart stuff, and we've been doing it since 1992. So, and we look at all 4 major asset categories. Don't just look at gold and silver, although right now that is our table pounder. That is the asset to focus on.
And I've seen, Michael, in your regular reports, because you put out a weekend report and then during the week there's stuff that comes out. You point out some of these same anomalies that you see in individual shares as well.
Yeah. So we try to find the outperformers. Anytime a sector is going up or down, there's going to be stocks within the sector that are outperforming the sector and underperforming or par. And what we try to do is every month we sift through most of the mining symbols. We try to define their relative performance to GDX, for example. Which are they doing better than GDX or not? And we plot that and we technically analyze it. And so there are always going to be miners that beat GDX on the upside. And that's where you'd like to prefer to pick the better ones. Although frankly, right now, I think you could throw a dart at the whole sector and come away smiling big time in 3 to 4 months. So
I can sure see how it all connects. Like you said, if the metals are going to keep going and those margins just getting
the miners are back to their highs.
Then why wouldn't
notice
they?
that?
Yeah, right.
The silver miners are back to their highs. Gold miners back to their highs. So the miners have suddenly said, hey, we're leaders now. We're not followers. And we're underpriced relative to that which we get out of the ground.
Yep. Fascinating stuff, Michael. Like I said, when Michael Oliver talks, people listen. Hopefully you've been listening, my dear reader, and that you flag this and go back and listen a couple of different times. Obviously, thank you, Michael. We've reached the end of February. I can't even, we're already a sixth of the way through the year. They say time speeds up as you get older, Michael. You agree with that?
Oh, yeah. And sometimes things get really good. This is a major event we're looking at here in the monetary metals. This is a lifetime event.